Barb, what's your take on the action we've seen this week, and what have you been doing?
Well, I can't disagree with Mike, and I think there could be more downside because I think we've seen a lot of false starts this week because the high flyers, have been hit by profit taking. I mean, we saw what happened in terms of the extreme valuations they ran up to. Got a little disconnected from their fundamentals, although the fundamentals are still good. So I think I'm waiting and watching. And when the false starts have happened, I'm like, oh my gosh, maybe that was the bottom. But I think they could go a little bit lower as people wait to see what's happening. Because momentum players are finding it's not as easy to make money right now. Because really the macro environment hasn't changed. The Fed is still providing unlimited support. I personally still think we see a slow recovery. And as Scott Gottlieb just said on your show a few minutes ago, we're heading into a seasonally high-risk time in terms of health and what could happen with the virus, et cetera. So I think you're still going to see a big impact on consumer behavior. So I think the market, once we've settled down here in the tech names, money will come back into the tech names, while at the same time continuing to slower rotation into more economically sensitive names. But I think it's still too soon to see a massive rotation into that. We just don't have enough strong economic signals. And I think we're not likely to until early next year, if then.
Peloton, meantime, posted its first ever quarterly profit, beating earnings expectations, though the stock is now well off the highs. CEO John Foley was on Squawk Box earlier today talking about the quarter.
We've grown 100% year-on-year revenue for 6 years. So this isn't kind of, we just didn't do this because of COVID. We believe what's happening here is a secular move from working out at a different location into the home. When you have a choice of working out at home with fantastic instructors, with a very supportive community, with the incredible gamified and networked software, and the best hardware now in the world, why would you travel? So we think that post-COVID, this is still an incredible growth story.
Mike, I know we touched on this at the top of that, but a fascinating intraday turnaround in Peloton and other names, of course, that we've touched on that had strong quarterly reports, jumped initially and have sold off intraday. What do we make of that and the kind of excess in the work from home trades?
Yeah, I mean, they just accelerated so much into this news. Actually had a couple of days where they, had intraday rallies and then sold off. It just basically says, what really is your next catalyst after you've seen these completely blowout numbers, and nobody quite knows if we've seen the peak of intense interest in this backlog and all the rest for the equipment. So I think it's a familiar dynamic where you have to reassess the stocks that have really worked out of a particular moment in time and try to figure out if you can count on them continuing.
Let's hit retail. BMO took a deep dive into COVID-19's impact on retail, found that a few struggling brick and mortar names may end up actually seeing a big benefit from being forced to close during the pandemic. The firm arguing that the reopenings provide a much needed reset for retailers that had been growing for growth's sake. And some retailers should stabilize their profit rates by deciding to permanently close stores. Gap, Nordstrom, and Victoria's Secret would benefit the most from closing stores, according to BMO's Simeon Siegel, while Tapestry, PVH, and Ralph Lauren will benefit the least. Barbara, it's an interesting notion that Simeon's been pushing for a while, which is shrink to grow, and that this offers sort of a once-in-a-lifetime opportunity for some of these overextended retailers to shrink their businesses, to right-size their businesses, to provide better growth stories. And we've certainly seen strength, for instance, in L Brands, which owns Victoria's Secret, and some of these others that have closed stores, Gap as well. Do you like that idea?
Yeah, I think it's interesting. It's funny because what he's talking about is really a long-term investable idea. It's more oriented toward the management side, I think. He's argued is that if you're well-capitalized, you are past your peak brand sales, meaning you're sort of on the downward slide there. This is a good opportunity to stop, expanding footage, stop trying to grow because it's not going to be profitable. And that the pandemic and the downturn is a good opportunity because you're not making money anyway, unless you are really well positioned like in Costco or Walmart, et cetera. So, he's saying, because the other part of his argument was not only to close stores, but also to raise prices and stop your promotions. Well, that may or may not work depending on your brand. You may just lose more customers because you're still very overstored. It's a very competitive environment. But in any event, what he's talking about is really, long-term restructuring of the industry. And he's just trying to identify those names that would benefit if the management went that way. So whether the management takes his advice or is in the midst of doing that is interesting. But I think ultimately he's right about that. But we'll see. It's up to each management to do what they need to do.